Welcome to Cafe Mutual YouTube channel. Friends, we all know about smart beta funds, and these funds are getting popular among distributors and investors. In fact, the AUM of this fund has now reached 22,000 crore as on August 2024. Smart beta funds basically track performance of index that are created based on predetermined formula or strategy to get better outcomes. One such strategy is momentum, meaning stocks that have high price movement than other stocks. To talk more about this strategy, today we have invited Arun Sundaresan, head ETF Nippon India Mutual Fund. Arun has over 2 decades of experience in the MF industry across sales, distribution, and product management. Arun is a chartered financial analyst. So without wasting time, let's invite him. Welcome to the show, Arun.
Thank you, Nishant. Pleasure being in the show.
So Arun, what is a momentum-based smart beta fund and how does it fit in investors' portfolio?
Nishant, like you said, smart beta strategies, they are variants on the broad-based indices or broad-based markets. Suppose you have Sensex, Nifty 500, or mid-cap, small-cap. You take those indices, which are generally considered to be market, do a variation on them by applying certain rules.
Hmm.
And if the result is a very different risk return output, which can possibly even outperform those broader indices, then you have those smart beta strategies. It is like this, you take a milk and
Hmm.
then, make a variant and prepare a roast milk on that, right? The texture, the taste, and everything could be different. So
Hmm.
there are a lot of such strategies or smart beta strategies available in the
Hmm.
market already. Momentum is one such strategy. So the fund we are talking about is on Nifty 500 momentum. I'll explain that.
Hmm.
But momentum as a concept again is very simple. You believe that something which is doing well, something which is performing, it will continue to do that in the near medium term. The momentum, the English word momentum, will take it forward, and something which is doing well will be, you bet on the winners type. So, like for example, if you take an analogy of cricket,
Hmm.
suppose a player is in a good form, you tend to think that the player will play well in the next match as well. It
Right.
may not, but the thing is, this guy is on in form, and therefore he is likely to do well. So momentum concept is very, very similar.
Hmm. Got it. And where does it fit in investors' portfolio, Arun, according to you?
So momentum, can be very different from a lot of strategies. So in general, a lot of mutual funds you will have general diversified portfolio which will invest across different sectors. The fund managers will try to identify stocks on future potential. It could be based on valuation and stuff like that. Momentum is a phenomena which is in stark contrast. So you
Hmm.
don't really rely on fundamentals. You don't see whether the stocks earnings are good or how likely it's to do well.
Hmm.
You purely go by the recent the stock performance, the performance,
Got it.
probably risk adjusted
Hmm.
performance and so on and so forth, with the belief that something which is doing well, it might be doing well for a set of reasons, and potentially it can continue to do well in the near medium term as well.
Okay. So, Arun, as you said that it basically captures the price movement of the stock. But what about the volatility part?
So the momentum in this particular fund is actually risk-adjusted price. In
Hmm.
fact, there are technical details. It's
Hmm.
called momentum ratio. So the
Hmm.
last 6 months and 1 year price upon the standard deviation. So the volatility is considered.
Hmm.
That momentum ratio for the last 6 months and 1 year. And then there are, of course, finer details like the Z score, where you take out the extremes, and then you figure out within those parameters which are the top set of stocks. So in a way, it adjusts for volatility, not just the price returns.
Okay. So, Arun, a simple principle of investment says that fund managers should buy something which is undervalued and sell it when the stock prices rises, right? But however, in momentum investing, it is completely different. You will have to buy stocks that are rising. So, can you help me understand how will investor makes money out of it?
So in general, what you're saying is true. If you take any commodity, you're buying a vegetable. So you will want to buy at a low price, a cheap price. And if you're selling, you would want to sell it at a higher price. So that's where you make profit. So when it comes to stocks, even in stocks, this is applicable, you should do that. But you may not really know at any point in time what is cheap, what is low, what
Mm,
could potentially go higher up, etc. It becomes very contextual. With the benefit of hindsight, you can analyze a lot of things, but in reality, something which is low might continue to be low for a very long time. It may
mm,
not go up for a very long time, and so on and so forth. So
mm,
while in general, if you can do that, great. You buy low, sell high. The concept of momentum is you buy high, potentially that can become higher. So
mm,
high and higher versus buying low and selling high. That's a
mm.
concept. Slightly counterintuitive and in contrast to the traditional ways of investing, but it does work, and it's quite an interesting concept.
Great. So, Arun, many experts believe that momentum strategy works well when there is rally in the market, and it may backfire during the market downturn. So, what is your take on this?
So when we looked at the data, so the fund that we are launching, Nippon India Nifty 500 Momentum 50 Index Fund. So basically, on the Nifty 500 parent index, which is the market or the beta. So we do a variation in this case, which is applying the momentum factor. As I explained to you, momentum is last 6 months and 1 year risk-adjusted price returns, right? So by doing that, you select the top 50 stocks across the market, be it
Mm,
large cap or small cap. You select that, right? Now it appears that momentum. You bet on something which is doing well, the hope that it will do better.
mm,
That it is likely to do well only in good markets. But when we looked at the data, we
mm,
looked at rolling returns,
mm,
the average returns for various periods of time. The
mm,
data is available for the last 19 years from 2005 till 2024 now.
okay.
So the 3 year rolling return,
Mm,
when we looked at that and compared with many other factor indices, there are other smart beta indices, almost 65-70% of the times,
mm,
instances, this strategy had outperformed. So this
okay.
is against other smart beta indices. When
Mm,
you start comparing this with Nifty 50 or Nifty 500, which are
mm,
generally considered to be market, right? The broad-based market-based indices, almost 80% of the times, based on 3 year and 5 year rolling return, this
mm,
has actually outperformed.
mm,
So that means that more number of times, higher number of instances, it's actually outperformed. Yes,
mm,
there are a few instances where this may have underperformed as well, but
mm,
75-80% is a substantial number in
mm,
terms of the number of instances is outperformed.
mm,
So there is no evidence, data evidence to suggest that it has
mm,
worked only in certain market conditions and not. In fact, the return profile is strong.
mm. So you have 19 years data. Then how did this index perform during 2008 crisis and the COVID times, and how it, I mean, overcame that period, that cycle?
So during sharp downturns or during certain market conditions, so we've talked about this in your show earlier.
Mm,
No strategy in the world, any strategy you take,
mm,
there will be instances it will outperform. There will also be times where it may not work, and some other strategy could work at that point in time. So this is part and parcel of investing, right? So that is why you should look at not only returns, over a longer period of time, but the return consistency. So the
mm,
data that I explained to you that over the last 19 years
mm.
on a 3 year rolling return. So on an average, the 3 year return has been 80% of the times better than Nifty 500 or Nifty 50, right?
Okay.
So there might be instances like extreme sharp correction like COVID or the 2008 correction. So those may account for the remaining 20%, time to time. Sometimes very very narrow markets. So those kind of things can happen, but 75-80% of the time, if a strategy when compared to another strategy is outperforming, that can be considered to be a very good profile in terms of potential.
Okay. So Arun, as you pointed out that Nippon India will launch Nippon India Nifty 500 Momentum 50 Index Fund. So what is the rationale for this launch, and can you take us through the fund briefly?
So this fund, the name itself suggests Nifty 500 is a universe. So we're
Yeah.
covering the entire market.
Hmm.
And on that, the momentum factor gets applied. So
Hmm.
momentum as defined in this index and in this fund is that
Hmm.
risk adjusted price returns for the last 6 months and 1 year. So 50% weight will be given for
Hmm.
the last 6 months and 1 year price adjusted for volatility. So it's called as momentum ratio,
Hmm.
and then based on that the top 50 stocks will be selected.
Okay.
Of course, there are finer details like a z score where the tail will be eliminated, and there are certain technical details as to how the 50 stocks would be
Yeah.
determined, and then there are other finer details like the weightage. So each stock will be capped at 5%,
Hmm.
and no single stock can be more than 5 times
Hmm.
than the underlying weight in Nifty,
Okay.
right? Nifty 500. So all these finer details are there, but by and large, what our viewers can keep in mind is the universe is Nifty 500. So this becomes in a way market cap agnostic, and within that momentum is applied,
Hmm.
but ultimately that stocks are also chosen basis the market cap. If, for example, if a large cap stock has a momentum which is similar to a mid-sized company, because the market cap is more for large cap, it will have a higher weight,
Hmm.
right? So in a way this can be considered as market cap weighted momentum,
Hmm.
right? And what it will end up doing is, suppose Nifty 500 has 75% in large cap, right? Now you're applying momentum on that. Suppose, the large cap momentum has been less and mid cap, small cap momentum has been more. So
Hmm.
the 75% will be lowered here. Maybe this fund will have 60-65%,
Hmm.
and maybe 30-35%. So at the margin you will have those variations, right? On the other hand, if mid caps and small caps have had a very strong momentum,
Hmm.
so probably it will have a higher weight than even 30-40%. So it will move across market cap depending on how the relative momentum works, and that gets combined with market cap ultimately to define the individual stock weights and the overall portfolio construction. So that's how it works. Net, uh, market cap agnostic, largely it moves across the market cap, a pure momentum play. So
Hmm.
wherever momentum is, by and large, it gets picked up, and then, that's how, um, the fund will work. So we'll look at, a lot of data. One of them was the average returns over a period of time. I talked to you about the return consistency.
Hmm.
Now, the last 19 years, the average 3-year rolling return. So at any point in time, if you had invested, you looked at your 3-year return, and the average of that 3-year return is close to 20% for this strategy. And
Okay.
just to give you a reference,
Hmm.
Nifty 50 and Nifty 500
Hmm.
for the same period, 3-year rolling, is roughly about 12.5%.
Hmm.
So there is a 3-year basis may almost 7.5% CAGR kind of outperformance in this strategy vis-a-vis, let's
Hmm.
say, Nifty 50 or Nifty 500.
Hmm. But what is the current composition? I mean, segregation between large, mid, and small.
So currently, it's close to about 65% in
Large.
large cap, close to about 30% in mid cap,
Hmm.
and roughly about 4-5% in small cap.
Hmm.
Now, this is what I just explained to you. You might be under the impression that last 6 months and 1 year, which
Hmm.
is the reference. This we are talking about as of June, which
Yeah.
is the rebalancing date,
Hmm.
and deciding the weightages, right? So the last 6 months and 1 year, we are talking about from June 23 to June 24. Markets have done well. So
Hmm.
you would think that mid caps and small caps will have a higher weight,
Yes.
but
Yes.
yes. So last 1 year, however, if you look at it,
Hmm.
all parts of the markets have gone up.
Hmm.
Large caps also have gone up. Mid caps and small caps have gone up, but
Hmm.
slightly more. But it's not a runaway. momentum or runaway movement of mid caps and small caps. So given this, combine that with the fact that large caps, the weight is already 75. So the output is that it is lower than 75. Mid caps and small caps have a higher momentum, but it is not so different that large cap is at 20, 30%, 40%. It's not that case, right? So right now it's close to about, as I said, 65% in large cap, 32% in mid cap, and 5% in small cap. How does this compare with Nifty 500? Nifty 500 has 75% in large cap. Against that, we are now 65. Mid cap typically is 17, 18%. Against that, 30, 32%. So this you can relate to, because last 6 months or 1 year, mid cap is a segment which has had the significant momentum, right? On the other hand, if you looked at the data 6 months prior, the previous rebalancing, the 6 months, 1 year, that particular 2023 calendar year, mid caps and small caps did significantly outperform. So during that time, the mid cap and small cap weight was close to about almost 60%. So it exhibits fair bit of flexibility in terms of market cap, and then within that it tries to capture the momentum.
Okay. Arun, one last question. Why should MFDs recommend this fund to their clients?
One, this gives you a very different risk return profile. Going by the past return profile, it appears to be quite attractive in the sense of the potential returns. As I said, when compared to a Nifty 500 or in general what you consider as market, it seems to have substantially given over 3 years something like 7.5% kind of alpha. That's quite substantial. You will appreciate and agree with me. So that's number one. Second, in terms of style, momentum is something again which is very unique. The general approach of most fund managers, most of these strategies would be to identify based on some valuation metric, saying that the P is this, valuation is this, and so on and so forth, identifying the potential for the future returns. But momentum as a concept is quite in contrast to it. It can be quite counterintuitive, so to say, where you are actually going with the recent winners, believing that they may continue their run for some more time. And because this has that 6 monthly rebalancing, every time the momentum shifts, it tries to quickly capture that. So, which is why it's not just in certain market conditions, but over a period of time in different market conditions, it has worked. So it can nicely complement existing portfolios and potentially bring to the table a strategy which can give very different returns from the markets.
Okay. All right, we have come to an end to this interesting session. Summing up, momentum strategy did well in majority of instances in the past, if we take the past record, and it can give better exposure, risk return exposure to clients. So thanks once again, Arun, for your valuable inputs and time.
Thank you very much, Nishant. Pleasure having the show.
Yeah. And finally, I thank each one of you for being such a lovely audience. Have a great day at work, guys. Bye.